All right, let's get right into it. There's this really compelling theory floating around that says we could be watching the very beginning of the end for the financial world as we know it. It's a huge story. Think global power shifts, a high-stakes chess game, and the possible downfall of the US dollar.
I mean, wow, that's a pretty dramatic statement, right? But it really sets the stage perfectly. The theory argues that historians of the future might pinpoint this very moment as the tipping point, when the whole era of American dominance, the so-called Pax Americana, really started to come apart. So what's behind such a bold prediction? Well, according to this line of thinking, it's all about the potential collapse of a system that's been quietly running the world for half a century.
And that system is the petrodollar. Simply put, if you're a country and you want to buy oil on the global market, you have to use US dollars. This creates this constant, massive, built-in demand for dollars, which in turn makes it the world's main reserve currency. It's given the US an incredible amount of financial power. But, and this is the key, that foundation is starting to show some serious cracks.
So let's look at the first part of this theory, the idea that this American-led order is kind of like an empire in trouble. The argument is that several different cracks are all showing up in the foundation at the exact same time. Really the worst possible time. The whole global economy is getting squeezed from a bunch of different directions at once, creating a sort of perfect storm.
Okay, so here's the crucial thing to understand. These aren't just isolated problems. You've got this huge, kind of fragile private credit market. You can think of it as a shadow banking system, and investors there are getting really nervous. At the same time, real job creation is basically flatlined. Then you've got the government piling on debt way faster than the economy is growing, and the cost to borrow all that money? It's spiking. And to top it all off, you have a major conflict brewing in the Middle East that could just pour gasoline on this whole economic fire. It's this toxic mix of stressors that's setting the stage for a real challenge to the old way of doing things.
And all this economic weakness, well, it opens the door for the second part of this theory, a global chess match over the one commodity that powers everything: energy. There are a few key players on the board here, and every single one of them has a crystal clear goal in mind.
So this chart lays it all out. On one side of the board, you have the US, which is desperately trying to keep the current system going. But on the other side, you've got this coalition of challengers. China's main goal is to become the new king of energy pricing. Russia, especially after its dollar reserves were frozen, is scrambling to find anyone to trade with in other currencies. Iran is using its strategic position to put the squeeze on the West. And then, caught right in the middle, you have the Gulf states, who are trying to play both sides to make sure they come out on top, no matter what happens.
Okay, so this brings us to the absolute core of the theory. The challengers seem to have realized something important. They don't have to go head-to-head and fight the petrodollar directly. No, all they have to do is build their own system, a parallel track that works completely outside of America's control.
This right here, this comparison gets to the heart of it all. The current system forces everybody into using dollars. But this new, alternative system, it creates a totally separate pathway. You use your own currency to buy a real, physical asset. Gold. Then you trade that gold to China for their currency, the yuan. And then you use that yuan to buy oil. See? It completely, totally sidesteps the US dollar and the entire US financial system.
So let's walk through how a deal like this would actually work. Say a country sells off its US dollar reserves to buy physical bars of gold. Then it turns around and sells that gold to China for yuan. It takes that yuan and goes to Iran or Russia to buy the oil it needs. And in this whole setup, China is sitting right in the middle, basically getting to decide the exchange rate between gold and oil, and by extension, what the dollar is actually worth compared to real stuff.
Okay, so you might be thinking, is there any actual evidence this is happening? Well, proponents of the theory will point you to data just like this. Right after the US froze Russia's dollar reserves back in 2022, there was this massive, undeniable spike in gold shipments from Switzerland to the Gulf countries. The theory is that this is no coincidence. Other countries saw what happened to Russia's money and had this uh-oh moment, realizing their dollars could be next. So they started looking for a financial plan B, just in case.
Now, to really grasp the potential impact here, you have to understand the scale we're talking about. The global market for oil, every single year, is just enormous. We're talking over $4 trillion.
But the entire annual market for new gold, it's less than $500 billion. It's almost 9 times smaller.
And this, right here, is the central problem. What happens when you try to funnel even a tiny piece of that $4.1 trillion oil market through the tiny, tiny doorway of the gold market? You get a potential demand shock for gold that would be unlike anything we have ever seen. The gold market is just not big enough to handle that kind of volume without its price going absolutely parabolic.
So while this whole geopolitical game is playing out in the background, we are seeing some really strange things happening in the financial markets. You can tell they are definitely feeling the pressure.
Take a look at this. For a quarter of a century, it was simple. Job openings in the stock market moved up and down together. More jobs meant people had more money to spend, which meant higher stocks. It made perfect sense. But right now, that relationship has completely shattered. Job openings are falling off a cliff, but the stock market just keeps soaring higher.
And this is the question that has so many economists scratching their heads. Why is Wall Street partying like it's 1999 while Main Street is showing all these signs of trouble? What gives?
Well, the going theory is that the market is making a gigantic bet on artificial intelligence. It's a bet that AI is going to make companies so much more productive that their profits are going to explode, no matter what happens to jobs or how much money consumers have to spend. Basically, it's a bet that companies can get richer even if their customers get poorer.
And this whole situation puts the U.S. Central Bank, the Federal Reserve, in what looks like an impossible bind. It's basically checkmate. If they cut interest rates to try and help the slowing job market, they risk sending inflation to the moon, especially if oil prices spike. But if they raise rates to fight that inflation, they could completely crash the already shaky bond market and send us into a deep, painful recession. There are just no good moves left on the board.
So with all these pressures building up, the theory lays out 3 potential ways this whole thing could end. And they range from a relatively soft landing all the way to a full-blown crisis.
Okay, outcome #1, the best case scenario. The conflict in the Middle East cools down quickly, oil prices drop, inflation fears go away, and that gives the Fed the green light to cut interest rates, which would send markets rallying. But, and this is a big but, even in this best case outcome, the world has fundamentally changed. That alternative gold-backed system, it doesn't just vanish. The shift to a world with multiple power centers just speeds up, and the dollar, while it would survive, would be significantly weaker.
The second possibility is a credit crisis. In this version, the war drags on. The pressure on energy prices just keeps building, and eventually bond markets around the world start to crack. Foreign countries have to sell their U.S. bonds just to pay for essential imports. And when they sell those bonds, it forces U.S. interest rates higher for everyone, triggering a major credit crunch and a severe global recession, kind of like what we saw in 2008.
And finally, there's the worst case. This is where the war goes on for so long that bond markets really start to break. The U.S. government can't afford to borrow money anymore. At that point, the Fed has an awful choice. Either let the whole system collapse or hit the print button on a massive scale to try and save it. But printing trillions of dollars right into an oil price spike is totally uncharted, dangerous territory. It could easily trigger hyperinflation and a full-blown crisis where no one trusts the government's debt anymore.
So, what we're watching is a high-stakes game of geopolitical chess playing out in real time. The old system is under incredible stress, a new one is being built in the shadows, and the financial markets are stuck right in the middle of it all. The only question left is, whose move is it, and which piece moves next?